think we need to do the generic, like, does it work? I think every video call starts with, does it work, to get going. But thanks for joining today. On this part here, we're going to be going through our industrial assets. Going to take a look at the market as a whole, and then kind of more define a little bit more specific on what our vision of industrial is, and what we're seeing on our assets and in the space we're operating in. So kind of limits us to the Southeast and typically smaller deals. But got Josh here, myself. So we are going to kick things off. And I think industrial as a whole has been pretty hot. It's like demand is demand endless. I think that could be a theme for industrial, and if that's actually going to continue to go forever.
And the biggest, this just in time, delivery service, just in time delivery, and the cost of transportation has really just relocated industrial. So industrial I used to be in manufacturing. My good friend Charles on the line. We used to go to manufacturing plants all the time. They were really just built in the middle of nowhere. And now, all new version industrial are all being built basically in suburban settings, right on the highway access, really close to urban centers.
Yeah. That's like the big industrial complexes, though.
Right.
You're working in different setting than what we're looking at. So when we think about industrial as a whole, normally you're driving down the highway and you see, 500 doors or 500 bays on the side of a building. You're like, wow, that's big. Industrial and warehousing, that all falls into that bucket that we look at. So when we're looking at industrial, it's not just like heavy manufacturing. We're looking at everything from warehousing to just big box flex to single user stores that are out there. But in general, all of that has performed phenomenally well over the past really 5 years.
Mm-hmm.
We, Josh and I together, we've been investing in industrial deals for about 10 years, mostly down in Texas, or only in Texas, I would say, kind of all over that area. So that's really where we were learning about it and just seeing how it was performing. Texas had some phenomenal growth. But then we look at Atlanta, we're based in Atlanta and in the Southeast, everything up 85 corridor. You drive up 85, whether you're going into the Carolinas or if you're going up towards Nashville, you see massive developments on the side of the highway. And those things nationally, the past 2 years, we've had over 500 million square feet of that type of asset come on board, which is staggering amount of space. And for the most part, we've also seen continuing to improve rents that whole time frame. And a big player in this space, Amazon, it's kind of like if you're going to build something, Amazon's going to take it mentality. We're starting to see that really end. Like, I think Amazon's come out and they've said that they're not just gobbling up any space that's available anymore.
Yeah, Amazon's really dictated the new construction build and the structure, the style, the access. It all has to basically be built to their specs. And then all the distributors that distribute through Amazon have to follow Amazon specs as well. So they've really been driving a lot of the industrial growth and infrastructure, basically requiring that new development has to be made because of the ceiling heights, because of the access, because of locations.
Yeah. And there's many things that driving that demand. I mean, the Amazon, the e-commerce push is about 10% of retail sales now. So there's definitely a push with that driving it. Also, just the sheer amount of stuff that people have been buying. The past 2 years, especially, I think, I'm not necessarily think, but like the demand of consumer goods over the past 2 years, not only have consumers had more money, they've also been spending more. So that drive is really pushing the need for this kind of space. And then logistics has been a nightmare. So all those things really have compounded to drive, one, the pricing and the rents that we're seeing in these segments. But I want to split a little bit, and that's kind of like the market as a whole. But our spaces, the stuff that we're typically buying is, say, 10 to 100,000 square feet spread across a couple buildings. So we have a lot of like 10 or 15 or 20,000 square foot buildings, and the supply of those has been not existent.
They're not building more.
They're not building any more of those. They're building giant complexes. They're not building like a 10 or 20,000 square foot building in ours. We are not seeing that in the Southeast that they're building. Mostly everything is suburban, highway, million square foot type of deal. Huge square footage
space. Yep.
And the stuff that we're looking to buy when we think about industrial is more of this already existing, gone through multiple uses, and more closer in than most new development stuff, right? So we're not buying something that's urban, but closer into the bigger city. So our typical user is only taking like 5 or 10,000 square feet. That's a main user for us. And there's been no supply added to that really.
Right. And predominantly catering to small businesses that have one location or maybe two locations on different parts of the city, but for the most part, one location that the flex design, which is generally speaking 30% office, 70% warehouse, is really suits all their needs. They can house their really front office infrastructure and team and call center in the front of it, and then all the storage from whether it's a painting supply place or whether it's HVAC or plumbing. We have one that was a spa.
Yeah, well, it sounds different.
They
it's
build
not a
jacuzzi. They build jacuzzi tubs. Yeah. So
yes, drop in like swimming pool jacuzzi tubs.
Yes.
Right. So you're storing that
a big giant thing.
And sometimes they're in pieces, but you need a lot of square footage for that. That tenant, for example, they had 7,000 square feet and they're looking to go to about 20,000 total, which is taking a whole building because that is 20,000 square feet is the building.
Yep. And they need to be, this specific case is in Norcross. Norcross is really just, it's very much in the center of Atlanta.
Interested to see. I don't know what direction you're going with.
Yeah, it's right in the heat pit.
We live right here, so it's like I wonder where he's going with this. But no, and those kind of things you don't want to be transporting those very far.
Right.
So once you've got your location here, their service area is pretty narrow. So most of our industrial flex users, their service area is very small. Right. That we're going for. So that's where we're at. That's the space that we kind of are looking at and looking to invest in versus what you kind of see as a whole on industrial and kind of what's happening with it. The market is building a ton, seeing huge driving in rents, all based on, really the Amazon growth was probably slowing and as they're trying to slow the economy down a little bit, their goal is to see a little bit of a decrease in consumer spending. So those things should put some downward pressure on the bigger industrial type buildings. Whereas the industrial flex that's closer, these smaller stuff. I mean, everyone is impacted if there's consumer spending that declines. But we're still looking at the smaller businesses that have a smaller operating footprint that they're going in.
Right. And then the other thing that industrial flex really competes with is really low cost suburban office, which obviously we do a lot of as well. And industrial flex is still priced about 30% below low density, low cost suburban office. So it still is really that value option for most users.
I mean, our first office was a industrial flex building. We had 2 different suites and we occupied that for almost 8 years that we operated out of a industrial flex space with, we kind of converted between storage and office, as we needed. Again, it was pretty darn flexible.
Yep.
So we were there and it was the cheapest rent that we could find.
Exactly.
So that's where we're still seeing our occupancy in this stuff has been doing very well because of that. Our go-to project is typically buying something that has some vacancy. And we've done that in the past, really with 4 different deals, our Kennesaw deal, our Doraville deal, Dawson Flex, which is what, you were mentioning. We just had a tenant that wants to negotiate more of space there. We bought that with 2 vacant buildings, and they're aiming to take over one of the full vacant buildings. Kennesaw is another example of a space where we had 4 suites that we whittled it down to 1 occupied and then leased out the remainder 3 of those. Doraville is 4 suites and we leased all of those out. Again, in that same, average 5,000 square foot tenant. I think one at Kennesaw was up to 9,000 square feet, but for the average 5,000 square feet. And we rented all of those in the first 2 quarters here that we were able to get between really 3 and 5 year leases, 4% escalations, CAM. Yep. So we're getting good, strong leases and seeing a lot of demand for that space. We don't have a whole lot of vacancy right now in industrial in our flex deals. We have a little bit at Covington and Dawson.
Right. One of the bigger opportunities on the market is that people that bought these industrial flex properties over the last 3, 4, 5 years, rents have run so much that they leased them up or signed or inherited leases in the $6 to $8 range. And now new leases are being signed between $10 and $12 a square foot with 4% escalations. So we can go in and they can exit a deal and be in a good position. And we can go in and take a deal and move it to a good position in a pretty short period of time and everyone wins.
Yeah, we're typically taking an asset and we're assuming that risk of releasing and doing that. We look at the Kennesaw deal. It was a deal that was 3 of 4 suites were occupied. Everyone with below market rents. And when we bought the deal, our plan was like, well, if they don't, they're either going to bring them more to market or they're going to leave. And 2 of them left, and then we were able to release them. That's, there's some definite work that goes into that, and there in time. I mean, from a cash flow on the deal, that was the first 9 months of not necessarily not having cash flow, but like we're not making distributions in that time frame because we are working on the occupancy story and the value story there before we're making distributions. So a lot of times that's a good situation where a seller could be motivated to sell something. And they're like, look, I don't want to go through that. I don't want to do that. I'd rather just take my money. I'm going to make some money on it. And these next guys being us, their firm can come in and do that kind of heavy lift to turn the deal around. So we still see opportunities with that. I mean, that's really the core of what we're looking at trying to find is those type of deals. We don't really have anything on the big side.
Yeah.
We're not doing any of those bigger deals. So we don't really have any is that going well or is that not going well? Especially with, we mentioned about 500 million square feet. That's a lot of absorption that needs to take place. If Amazon slows down, the news or the general media is going to be more time about that type of demand versus the existing 20,000 square foot flex building, that's owned by basically smaller players in the space. And most of our stuff, when we look at our building sizes, we don't have 40-foot ceilings. We're not talking about those kind of assets. If we have 20-foot ceilings and some dock has some ground level access, that's fine. Our users can, they're adaptable to either one of those really. So we're seeing that as our go-to target still, and we still see opportunities then, even with rates rising. Rates on the debt side are definitely increasing, but maybe it helps a little bit in the sense that it slows down just the rampant demand. It's like,
yeah, and industrials have been on such a run for so long, and cap rates are just coming lower and lower and lower. That especially in the flex space that we're in, deals trading at 4 and 5 cap rates is kind of absurd.
We haven't bought any. Yeah. By the way, we have not bought any of those. We don't plan to buy any of those. But there have been deals that have transacted in that range, and that's a tight margin, even with what debt was when they were doing those.
Right.
You're ultra close on your spread, and that's just not. We're not necessarily cap rate investors. We're more cash flow investors. So if we can get our cash flow and we can have a spread on a deal that looks solid and we know we have future value growth, that's where we want to be. So we're not buying solely on cap in, cap out transactions. So if we can find good spread opportunities, we're going to take them and we're going to do it. But we don't have too much right now that we're seeing. There's kind of definitely a slowdown this month of like what's coming to market that's in our sweet spot. There's definitely lots of huge stuff, but it's not what we're going for. Or what we're
the flex that we've bought and that we're continuing to look for reminds us of our early basically multifamily days, where you're buying from either a patriarch or some mom and pop operator that has really kind of milked as much as they can out of the deal, and they're ready to really just move on. And we're able to basically buy those, aggregate them up, put on professional management onto them, and operate them all for cash flow.
Yeah. And almost all of the stuff that we've been talking about, I mean, we just bought our deals in Columbia, South Carolina. And then we have most of our portfolio is here in Atlanta, Atlanta Metro. Right. So those are the two core markets that we're operating in right now. I mean, we're looking all over the Southeast and trying to find stuff. But right now, our biggest stuff is really here in Atlanta and then Columbia, South Carolina. And the demand that we're seeing in both of those two markets has put us in a very high occupancy situation with good escalations on our rent, and all of our debt is fixed. So we're in a good position right now with cash flow and making continued distributions going forwards. We only really see our margins improving because we have our growth, we have our fixed debt, and a good percentage of our costs are then passed through on CAM. Now we don't want those common area maintenance costs being too high and pushing our tenants out because of costs going too high, but everyone in the market is seeing. We're not, we don't have necessarily like special sauce that's making our landscaping costs cheaper than someone else's
Right.
when we're doing it. So right now, going forwards, still saying narrowly focused on the deals that we want to find, those smaller flex spaces. Again, the maybe 20 feet high, the dock doors, we can alternate between what we have, but we're looking for those. And we think we can still find stuff. And we're still seeing debt that's in the 5% range.
Yeah.
Which is not.
It's reasonable.
Yeah, that's, yes, it is not
It's
2.5%. We were never really getting that anyway. So 5% is not crazy. I think we're okay at that debt level, and we'll be able to find deals where that debt works. And again, we're only going to be looking at fixed debt. Whereas that's kind of been our bread and butter for 10 years. Even at some points when the floating rates were certainly probably more attractive.
Right.
I know people that did a lot of floating rate earlier, and they did just fine on those. And we didn't. We've always kind of been fixed rate debt guys.
Control the things you can control.
Yep. So we're going to stick with that strategy. We're going to keep looking at getting fixed debt on these deals. The other part that does with the fixed debt, though, is it kind of shortens our acquisition timeframe. Banks in this situation aren't willing to give you an interest rate lock for like indefinite amount of time. So it does condense our closing timeline a little bit, but that's okay.
Yeah,
so,
it works.
Yeah.
And so as we look forward and at the properties that we're looking at right now, in the next couple of weeks, we'll be putting out a deal off Pleasantdale Road at, which is in the middle of Norcross, which is in the middle of all the other industrial flex deals that we own, with the exception of the one Kennesaw and the Columbia ones.
Covington. We got some other stuff out there, but yeah.
Yeah. So it's really just the traditional deal that we've looked at. It's more rinse, wash, repeat model with our flex properties. It's 50,000 square feet. We're buying it for roughly $100 a square foot. There's some tenants that are great that we're going to keep there, and we'll just work on their escalations. There's some tenants we're going to turn over and bring them up to market. And just really more of the same that you've seen from us in the last several deals. Yeah,
it's our go-to deal on that. And I think we're launching that one out on 2 Thursdays from now. So I think the 17th. What is it now? Not sure on that exactly. 2 Thursdays from now, we're taking that one out. So we're excited about that one. That's another one we've been able to find in this market that fits exactly into our box. And with all of these, we've been able to make, other than the ones that we did value add on, like we mentioned the Kennesaw deal, where we had 9 months of vacancy and moving someone in and paying for TI to get that going. Other than those value add ones, we're making distributions on the deals as they're all cash flowing. So. Okay, we're going to open it up for questions. If there's anything else we didn't answer, we got Melody here too. She's going to go through some thoughts that are out there and see what else we can address on the industrial side here.
All right. Are you looking to buy fully vacant buildings, then convert or lease the space?
Fully vacant. So fully vacant, that's when we talk about having a pretty narrow focus. We want to see some vacancy, but fully vacant is a little off our radar. We just feel a lot more comfortable going into something knowing someone is using it for something to start with. So no, we probably won't be doing anything that's fully vacant. Josh is laughing.
We had a funny conversation about this yesterday. We were looking at a fully vacant, brand new built deal that was completed 9 months ago, and we both just looked at it like, "Why is it vacant? This is the highest demand flex market in the history of time. It's been sitting for 9 months. Why is it vacant?" Like,
I think flex got created about 10 years ago.
Yeah. So we just kind of shrugged our shoulders like, there's got to be a reason why it's vacant. There's something wrong. I don't know if we care enough to go figure that out on a full.
Yeah, no, it's already, especially if we can go into any space. There's so many different ways that people are making money out there. There's so many other businesses that I never even heard of. When we're like, oh, we learn something every time we go and see a base that has occupancy in it, and it helps us identify how we're going to build that thing out and gain occupancy. So in the short, no, we probably will not be buying anything that's fully vacant.
Yeah, we have looked at quite a bit of a full building that was leased by, like the doorbell deal was leased by the seller, and he was vacating upon our purchase, but it was fully built out and he was using it up until the day we closed.
Oh, right.
So
we closed with conditions of, hey, you need to leave so we can release this. Yes.
And at least we leased the whole thing in 60 days. So it worked out great.
All right. So what are the costs associated with converting a big open box to flex? And how do you know which box is a worthy investment?
So we're doing that with Dawson
Yep.
right now. That's on the game plan there. And two parts to that question. One, we're taking something that's like 20 or 30 or 40,000 square feet, dividing that into smaller suites. One, the building has to be laid out so that everyone can access kind of in the front and then leave in the back. Right. So you got to have this through mentality of working it. Occasionally you can sneak in the side doors or something like that. But first, the building's got to be set up to be able to do that. Right? That's kind of key.
Mhm.
And lots of things. I mean, that means each suite needs a bathroom. Right? You need to have plumbing, electrical divided out for each one. And sometimes we look at a lot of these buildings and that stuff has already actually in place and it lends itself to be more adaptable. So that's when we say, is this building good for it? Well, sometimes a lot of that has already been done. So we can take what's there and really work with it to enable this flex conversion to happen. The cost associated with that. It's a balancing act between two parts of the cost. The first is just doing the division. The second is the tenant.
Right. And, a lot of the costs, the warehouse is the warehouse. We're not really changing the walls or the depths or anything like that. It's really building out that 30% office and how much that tenant really wants to build out. In general, we're budgeting give or take $25 a square foot. So basically take it from a shell to divide it up to put 30% office into. And that seems to be working. And that's been our approach with this project.
Right. We've done it on a couple.
Yeah.
We've done it on a couple of them now. And that has held true. But then also the tenant is going to go in and do their own thing with that space too. So they'll probably add some more spend into that footprint to make it more what they want on the inside there.
If e-commerce slows down or spending slows down in a recession, will that stop new demand for these type of assets?
Well, so on our side, I mean, on the larger side, the news we're going to hear about, I think yes. Right. If Amazon isn't going to sign any more leases because they're more going to optimize what they currently have versus it just blatantly expanding. I see anytime you think about or even talk about, hey, there's going to be a slowdown. As soon as you start talking about it, you're already mentally preparing for it. And you're thinking about what am I going to do in my business to more optimize what I have versus just expand because, hey, I think I'm going to use the space eventually. So I would say most people are going to look to optimize what they have. And even when we look at our tenants that are more like small businesses or localized distribution, you look at an HVAC company, they're going to just optimize how they're using that current space as opposed to expanding into new space. That being said, that doesn't mean that all expansion is off the table and no new businesses are going to do anything. Like that's an economy that's stopped. I don't think even a recession, there's still things are happening and growth is happening. So our spaces, the thing that we're focused most on is that there's just not a lot of supply. If you want to get into a flex space, you still need to act pretty darn quickly. There's not a lot of it out there and there's barely any of it being built.
A submitted question regarding debt. Do the interest rates typically follow the 2, 5, or 10-year treasury for which the curve is currently inverted?
Probably close. We're generally doing 5-year debt. It probably follows closest to the 5-year treasury with a spread on that. Banks manufacture their own swap rate, which somewhat follows the 5-year treasury as well. But that's probably the most. So the 5-year treasury spikes. It's probably going to cause other things to spike, which is going to drive up interest rates. But then what happens is they start softening spreads. So for example, we were looking at multifamily earlier today, and the spread on multifamily that they would put a spread on the 5 or the 10 or the 7 or the 10-year treasury, and they would generally be 230 to 250 basis points. And now it's come down to about 160 to 190 basis points because the treasuries have run up so much.
We saw that in 2020 across the board where spreads became huge. It was like they're over 300 points. It's like, what the heck?
Right.
Like that's a big spread. Like, what is going on? And that was on all assets that we were seeing these huge spreads. And now, even though rates have come up, right? Even when we track the 3, the 5, or 10, whatever, the spread that's being quoted to us on the debt term is now a lot more compressed against all three of them.
Yes.
But we're tracking the 5-year too, because most of our loans track against the weighted average lease term, unless we have one tenant that's like a
Right.
dominant force in that space, which we don't typically have in our industrial deals. We don't really have large scale credit tenants that are driving the loan in our type of industrial flex. So more it's the average lease term that we're going into with tenants. And we're typically signing, we're targeting 5-year leases. Occasionally we'll get a 7, targeting 5. So most of our debt is on that 5-year term as well, which then matches the 5-year treasury. So I think that is probably specific to us versus the market as a whole, that we're trending in this, we're playing in the 5-year space.
Yeah. And it's mostly our lenders are community banks. This is a community banks lend. The other metric they follow is what's the new name for LIBOR? SOFR?
Oh, I know, like they're going to get rid of LIBOR. That's been on the table forever.
Yeah. So I think
Right.
SOFR is I can't remember what it stands for, but it's a spread on SOFR. But you can also trend LIBOR. But yeah,
It won't be a couple guys in a room arbitrarily changing the rate up and down to make money. But no, we look at Wall Street Journal rate too.
Yep.
That's another one that comes into play on how these things are quoted for us.
Yep.
And our process question, quarterly reports are dated for the end of June, but when do distributions actually arrive?
This one's a recurring theme that we're getting out kind of at the end of the quarter here on how our distribution process works. The first part, we've really tried to be consistent in making sure that our information goes out on the 20th day following the end of quarter. And then typically we're doing our live streams, we're doing presentations and discussion on it about a week or two later. This one we waited and did it a little longer because of the Fed meeting on the 26th and 27th. So we want to do this after that meeting. But for the most part, when we close our quarter, we put our distribution notices in Juniper, our investment management platform. We do that for the end of June. So they show up as happening or occurring at the end of June. They really don't go out until the 20th day after the end of the quarter. And for the most part, they're going to take a day or two to hit your bank account. So they'll be typically around the 21st or 22nd that you'll see those distributions hit.
And those are all the questions that have been submitted.
All right. Well, thank you we had some good questions. Thank you for the participation. And thanks for tuning in on the industrial segment. And we'll see you all soon.
Thanks, everyone.